Thank you all for joining us this morning for this presentation relating to our interim results for the period ending 31st of March this year. This presentation will take you through a number of headings presented by both myself and Charlotte. The next slide sets out the agenda that we are going to follow. I'm going to take you through the service offerings, the operational highlights in the period. Charlotte will cover financial, regional and cash flow. And then we'll both do summary and outlook. I'm very happy to take your Q&A at the end on any of the issues that are raised or that you'd like a bit more detail on. So moving forward into our service split, you can see in the brackets there what the position was at the half year last year for comparison purposes. 20% of our business shown in the gold sector is the project services business we have in the UK, having closed them elsewhere in the world where they weren't profitable. And then we have Dialis and Driver Tret roughly equal in the period last year. A slight swing this year, but that relates to the starting and completing of a number of large projects. So in any short period, like 6 months, there will always be some swings to and from. And one does need to look at underlying data, which I'll do in a moment. Because we are going to be rebranding Driver Tret and consolidating to Dialis branding globally, an important thing for us to do. When you next see this diagram, if you join us for the prelims in December, the diagram will look a little different. And if you could give me a click, please, Hannah, you'll see that we will be consistently branded across the world and only having Dialis as our common brand outside of driver project services in the UK. So that's what it will look like moving forward. And that story is also picked up from the next slide, which talks about service split. Very small business in Americas, but that's the kind of split that we expected and started with new businesses. Didn't have project services there, so hence the 0%. Fully closed now in the Middle East. The Middle East has been a project to unwind a number of things, including businesses that weren't adding much value and some cash that was locked up. That's been a big project for us over the last couple of years to unwind and move out from. And you can see that there's some expert work going on there, and it's relatively small at the moment because that's to do with the number of experts based in the region. So moving on to Asia Pacific, similar story. And then if you put that all together, these trend lines show you where the business is going. And the lower trend line, which is dotted and in a deep red color, is rising from left to right. And then the teal line at the top that is dotted as a trend line is dropping. Now you can see, as usual with our business, there are significant peaks and troughs. And actually, Dialis during this period last year, because of a couple of big jobs, had already become the dominant business. But regardless, the overall trend lines show that from about the middle of 2025 onwards, that will be the case, that we will predominantly be delivering on big expert work rather than on as much claims work as we did in past. So hopefully that supports the logic and people can understand the peaks and troughs, but the trend is the thing to watch and to look out for. If we move to the next slide, I'll give you the overall highlights for the period. We set out a fairly bold transformation strategy in December of last year. We're making good progress with it. There's lots of work behind the scenes to make something like that happen. We have maintained group profitability in the period. Our Middle East and APAC businesses are returned to profitability and are much smaller and more stable than they have been in the past, certainly pre-pandemic and in the period immediately following. Our share buyback program was announced, or at least the initial tranche announced this morning. £250,000 put to that, and the board will keep that under close review whilst we are evaluating some of the talent acquisition opportunities that we said that we would be seeking, and we've been building a pipeline upon for the last few months as part of that transformation strategy. The UK and Europe is expanding as a central business hub and continues to become the sort of dominant centre of the business, particularly with larger and more complex projects. And those relationships between centre and the individual worldwide offices is important. And there's a cultural shift that we're bringing about there. I'd say we were perhaps 2/3 down that road, perhaps a little further, but these things are difficult to deliver overnight. They tend to take a period to actually deliver upon. We're going to be increasing the number of experts. We've got a couple of great starters lined up already. It takes many months to secure, and then people have to work their notice. And so there is a time lag there, but a great deal of work has been done on securing additional experts to come into the business. Some of our new business tools allow us to see our pipeline of opportunity now moving forward, and the number of opportunities in each given period won, lost, or pending. And so that gives us some trend mapping across the globe for the effectively the buoyancy of the market in a given region, which informs our decision making. And these are tools that we've not had before, along with some real-time management information tools now being trialed that come out of having a fully operational ERP system, which we installed a couple of years ago. And the finance team did a great deal of work and fantastic job to actually get working and become effective. We'll start to see that paying back, hopefully, as time moves forward. And if we move to the next slide, I think Charlotte's going to take us through the numbers.
Thanks, Mark. Revenue from 6 months to March at 22.5, that's stable to the same period last year, delivering a gross profit of 6 million. A small reduction there in admin expenses, which is part of the cost saving exercise we've been undergoing over the last few years. Underlying profit of 0.6, a small charge there for share options 0.1, giving a profit before tax of 0.5. We do have some ongoing costs from the operations we're closing that Mark talked about in Oman, but also in Kuwait, Hong Kong and Malaysia. So there's a charge there of 100, realising profit for the year of 0.3, which is the same as the period last year. The next slide shows some of the main KPIs that we use to measure the business. The gross profit margin is stable at 27%. Utilisation increase, this is the one that we focus on the most and can have a positive impact to the bottom line. So that increase there is something that we're seeing continuing in Q3. Earnings per share has increased from 0.6 to 0.8. Net cash has reduced, and I'll take you through the reasons as to why that is in a minute with the bridge. That delivers a net cash per share of 6.8, down from 10.1. It's a sector leading dividend yield there still of 6%. Take through the regions, Europe and Americas. Slightly reduced revenue to 14.1, giving a lower profit. We have managed to increase the headcount there. Utilisation slightly down, and that's why the profit is down, but that's something that we're working on and have seen improving in Q3, as I said just a moment ago. The next one, please, Hannah, is DPS as a standalone. Very different style of business. So a few years ago, you'll recall we started showing this separately. Revenue stable at 4.4, delivering contribution of 0.4 on a headcount of 92, with a very strong utilisation there of almost 94%. The next slide is the Middle East. Whilst the revenue remained the same, it turned from a small loss into a small profit for us to build on. Positive increase in utilisation. That team is now steady at that headcount number. The reduction in those 2 periods there is the closure of Oman. So in the Middle East, it's steady and should now be contributing to Central. Similarly for APAC, revenue up there almost 30% to 1.8 million. That includes some work coming out of Korea and some secondments we have there. Again, turned the loss into a profit. Small contribution, but something we can build upon, and an increased headcount and increased utilisation delivering that profit. Turning to cash, which is the next slide that I talked about, we did generate 800,000 from operating activities. Lease charges was 300,000. The big reduction there is 2.1 on working capital. I'll give you a bit more detail of what's in there. We had 800,000 payment out to the JV that we announced in December we were bringing to a close. That had been in place for a number of years. There's no charge in the P&L for this year for that. It was all accrued in previous years. It was cash movement. In Canada, the other side provided us with back office support and office space. And in Dubai, the Middle East, they did the opposite for us. And then we had some profit share arrangements that have gone back a few years. So we've now closed that agreement and paid our dues on that. Also within there is £400,000 related to London office. We had a period of double rent for a quarter while we were doing the deal ups, I suppose, on the old property at Cannon Street. So 400,000 cost in there. The rest of it normal working capital movements. Small amount tax paid, 200, dividend 400, 100 at the end there on foreign exchange. That all totals 2.2 reduction in cash to 3.6 at March, but 31st of May that had recovered to 4.2, and as of this morning is 4.6. It's back to more normalised level that we would expect to see cash this time of year. March is always our lowest point. Next slide is outlook. Come back to you, Mark.
Indeed. So a lot of work over the last 6 months on that transformation strategy we announced. Rebranding to DLIS, which is a brand consolidation effectively globally, is a really important step along the way, due to complete next month. And that is actually the first time since I've been in business, which is 17, 18 years now. That's the first time that we will have been approaching the whole market globally with the same brand in a coordinated way. And that's a legacy thing of bits being bolted on and things being started over time with different names, different brandings. And it's been something of a pickle. So I think it's going to give us better value and a much clearer, cleaner, fresh approach to go to market. Our European and UK businesses have always performed well. They sometimes have peaks and troughs, but generally nothing like the swings that we see further abroad. And that's the thinking that's driven a lot of our transformation strategy. Our management know that they need to be focused on improving utilisation as a KPI, and we can see evidence that that's beginning to come through. Great to see both the Middle East and APAC contributing positively and expected to do so moving forward as well, which is of course of key importance. Both Asia Pacific and Middle East have their focus areas, the Korean initiative in APAC and the projects in KSA, a number of which have been secured for Middle East staff and for people from the UK as well. We will always have short-term revenue visibility issues. The next 2 or 3 months, though, we can see there's a pipeline of opportunity. Our staff are busy, which means our Q3 revenue and utilisation gives us more confidence in H2 than we would normally be able to have at this time of the year, given the short range visibility. The other thing that's important for us to do, because we said that we wanted to grow our talent in our DLIS expert pool by within the transformation strategy, is to build a bit of a pipeline of people that we want to acquire, and that talent will be acquired by acquisition of small businesses, or what I've often termed as the acquisition of talent, where we may bring in a team from another business. So quite a lot of work going on there to pick up on what we said we'd be doing in the transformation strategy. I think over the next few months and certainly the next year, you'll start to see some of the benefits come through of the steps that we've been taking. So in summary, and as an overall strategic update, Europe, UK continuing to expand and consolidate the position as a central business hub. Our transformation strategy is progressing well.
We've maintained the dividend at 0.75 pence, a total of 0.4 million. We this morning announced the initial share buyback programme of 250,000, and the cash balance at the 31st of May has increased to 4.2. Profitable trading overall in H1 with a profit before tax of 0.6 from continuing operations, and both the Middle East and APAC have returned to profitability and are contributing to central.
So our focus remains on retaining our staff, keeping them busy, hiring some new great people to come in and join our team, collecting the cash for the work we do, and making sure that we keep an eye constantly on our costs. Simply a case of getting the basics right. And that concludes the presentation that we've provided, Hannah. So if there are any questions, we'd be more than happy to try and answer them.
Where do you see the split of the business by division in 3 years' time?
Well, we will have already transitioned to Dialis, so I would expect, because the project services business is likely to give organic growth, and growth will be more accelerated by acquisition of talent in Dialis overall, that you might see revenue up somewhere into the early 50s. I would have thought. We're not looking to grow it aggressively. We're focused on making it more profitable. You might see that project services becomes a slightly smaller part of the business because we expect the growth to be in Dialis.
Okay, thank you. Can you explain how exiting a small JV can lead to a cash outflow of 1.8 million? Surely this amount exceeds all the possible losses of keeping a JV going.
It's 0.8 million rather than 1.8. Apologies if I said it incorrectly earlier. It was a build-up that was about 5 years of profit sharing that hadn't been paid and was settled. So it's not one period.
Okay, thank you. And I suppose following on that, despite your efforts to exit problem regions, the receivables balance remains stubbornly high. How much of this is still currently overdue?
The overseas part is very small, and locked up old debt in the Middle East is only a couple of 100,000. Of our aging, 70% of it is within 3 months of that figure. Obviously changes constantly. We do have some older debt that's provided for. We have some judgments out some parts of the world, which we may or may not get in, but they are provided.
Okay, thank you. In view of the level of net cash, why you only utilise 1 million for share buybacks and acquisitions and not more?
We do have a requirement to keep a balance in every overseas jurisdiction. We try and minimise those so that we can repatriate as much cash as we can to have our deposit now that we're finally getting some interest on that, or to use for acquisitions. And so that can be around 1.3, 1.5 million pounds that we have to leave elsewhere. That reduces it. And then we have working capital cycle that we have to obviously cover. So we wouldn't want to leave ourselves with too short a headroom. So we make sure in our forecasting that we've allowed for that.
Okay, and another one for you, Charlotte, and then we'll come to you, Mark. You mentioned that net cash improved in the 2 months to May. Is this a reflection of positive trading or an unwinding of working capital?
Positive trading, really. March is traditionally a lower cash point, given that we've had our lowest billing month in the year from December, because it's a short month with the holidays. So that by the time that's worked its way through the working capital, it hits in March. We pay bonuses at Christmas, so that's an extra cost. It's a high VAT quarter. We don't pay many rents quarterly anymore, so that doesn't really affect. But we expect it to be in our working capital cycle a low month. So we're covering to our cash balances now more normalised levels that we would expect in our forecasting.
Okay, thank you. What is the trend of the type of contracts coming out of Saudi Arabia and Korea, as they've been mentioned increasingly in the most recent results?
The trend from both of those regions is that what we get are larger commissions that go on for many months and sometimes more than a year. And that's because the projects are much bigger, and so the challenges are much bigger in order to work with them. Generally, the work that comes to us from Southeast Asia is work that has already reached a dispute stage and is already moving forward to that. A number of the projects that are coming out of Saudi Arabia are still on projects that are live or ongoing or about to be started, where there is limited resource, very challenging and imaginative things to be built that have not been built before, and we're finding that we're getting earlier involvement.
Okay, helpful. You've mentioned you're targeting acquisitions up to £250,000. Typically, what should that buy, and are you looking at entering new but complementary areas?
I'm not sure we said that we're looking at acquisitions up to 250,000. I think what we said was we've allocated 1 million. We've got 250,000 that we've set aside for buybacks at this time, which leaves a current budget of 750 there, which would be the first year cost towards one of the larger end of what we might acquire.
Important clarification, thank you. Do you see any long-term risk to quantum analysis from AI?
Do I see any long-term risk? I have not yet seen any form of AI that could do that reliably. I appreciate that people will try, and I appreciate that some people will say it can. But these are complex projects and that need many years of experience to interpret and work on. And the timing of us being replaced by machines, I would think, is somewhat longer than the next, certainly longer than H2. Now, I would suggest a number of years away, so I think we're probably on relatively safe ground for now.
Thank you. Why does acquiring expert teams require upfront cash payments that may reduce the buyback amount?
I do apologise, Hannah. Can you give me that question again? I'm not sure I fully understood that.
Sure. The suggestion is, why does acquiring expert teams require upfront cash payments that may reduce the amount available to you for buybacks?
Well, if you are going to, and many of the people watching this will probably work in businesses or certainly be well aware of businesses where there are a number of rainmakers in the business who are key people who are paid a lot of money and really quite important to that business. And if you want to hire someone like that, there is a process of going to seek out that person and then convince them that you'd like them to come and bring their team with them. And in the current market, that will often require some kind of golden hello, which is coupled with a lock-in for a minimum period of employment. One has to do something to prize these people out of places that they're currently in and prize to be with it.
Thank you. If scale is important to this kind of business, would the company not be better off selling itself to a larger consultancy business rather than acquiring other businesses?
Well, I'm not sure that it works that way with the executives of an AIM-listed business, but we're open to receive offers, aren't we? If someone would like to come and visit us, but in the meantime, it's possible that this business might end up at some point in the future as part of something else. Who knows? In the meantime, this executive is focused on growing margin, and the way to grow the margin is to hire some real experts and grow our expertise team and make us more attractive from that perspective.
Very, very sensible answer. Is the ERP spend now complete and the system delivering the benefits anticipated?
Yes, spend was complete probably the year before last. We do have ongoing, licensing costs, of course, and very few external programming costs. We're managing that in-house. The phase we're moving into now is to start using that information through a dashboard so that we can deliver with the team and the office managers more reliable, up-to-date, real-time information to help them manage the business and improve the bottom line and utilisation. That's working well.
You've discussed positive new inquiry pipeline. Is this mainly long or short-term or a mixture?
A mixture.
Well, that is it for the questions, which just leaves me to thank all our attendees for joining us today and to you both for answering their questions. And we'll look forward to an update in 6 months' time.
Yeah, we'll look forward to seeing you then. Thank you very much for joining us.